Welcome to Satya Skills. In this video, I would like to introduce you all some of the important members of stock exchanges. Stock exchanges are common platform for buyers and sellers of corporate and government securities which are already issued and purchased by investors in the primary market. When such shares are listed in the stock exchange, any individual or institution who are throughout the world can buy and sell them through stock exchanges. Only members of stock exchange can buy and sell on behalf of sellers and buyers. Non-members are not allowed to enter into the trading floor of stock exchanges. Business can be transacted by members who are admitted by the stock exchanges as members. And admission procedure is uniform in all the recognized stock exchanges. It is based on the provisions of securities contracts regulation rules. The following are the few important essentials. They are like a person should be a major and he should be a citizen of India. Non-citizens, they have to get approval of the government of India, and he should not be a bankrupt. This is important, and he should not be convicted of any offense like especially fraud. He should not be an employee or a business person other than security business. He is not declared as a defaulter by any other stock exchange. And here one important thing is that the stock exchange deals with several acts. Therefore, every member need to have some basic knowledge, some technical knowledge. That's why they say that minimum education qualification of SSC or matriculation is to be there, and of course there are training institutions that can provide some basic training to members, and members can be individuals or can be companies also. Candidates who fulfill the above conditions can apply to the stock exchanges, and the applications are scrutinized and final decision will be taken by the governing body. Governing body is the organizing body of stock exchange. Now, after admission into stock exchange as members, they should pay entrance fee, registration fee and annual subscription that differs from one stock exchange to other. A member of a stock exchange can also be a member of other stock exchanges. This is called multiple membership. This is allowed in India. Sub-brokers. Stock exchanges are located in different cities, but investors are spread throughout the country, sometimes outside the country. Therefore, brokers appoint sub-brokers in different parts of country to deal with buyers and sellers of securities in those areas on their behalf, on the behalf of brokers. Sub-brokers are not subject to Securities Contract Regulation Act. They transact business only on behalf of brokers. Sub-broker cannot issue his own contract note. Business turnover of the sub-broker is counted in the turnover of the main broker. That is sub-broker and main broker, they make some arrangements with regarding to payment of fee collection. And here SEBI prescribed, SEBI means Securities Exchange Board of India, guidelines for the appointment and responsibilities of sub-brokers. Then foreign brokers. Government of India permitted institutional investors to buy and sell securities in Indian stock market. Therefore, foreign brokers are allowed to transact for them. Foreign brokers should get a prior approval from the government. Guidelines with regard to the admission of foreign brokers are issued by the SEBI. Then jobbers. Jobbers are also the members of stock exchange who sell and purchase securities in their own name. Jobber is not allowed to deal with non-members directly. They do not work on commission basis. They are usually found in London Stock Exchange, but usually they make two-way price, like two-way quotes we call it, no? Both buying and selling price. They usually specialize in a particular group of securities, but in Indian Stock Exchange There is no strict distinction between jobbers and brokers. Next category is speculators. There are two types of investors in the market. Those who invest to gain regular income, one category. Others, they buy securities to sell at higher price to make more profit in short term. These are usually second category of brokers or dealers are usually called speculators because they speculate and take risk for high returns. There are different types of speculators in stock markets throughout the world. Depending on the nature of their behavior, they are classified into 4 groups or 4 classes and they are given 4 animal names. The first one is bull. Bull usually lifts its enemy in a fight with its horns. In stock market, bull is a speculator who make purchases of securities with a hope that prices will increase in future so that he can sell them at higher prices. If prices in the market are continuously showing rising trends, it is described as bullish market or bull is raiding. Second one is bear. Bear is a wild animal which suppresses its enemy in a fight. In a stock market, bear is a speculator who expects fall in price so that he can take advantage of selling securities in a future date where he can deliver securities when market price is less. But he enters into an agreement with the investor at a higher price. It implies that he sells securities which he does not possess with an agreement for future delivery. Such practice is called short selling. Another one is lame duck. First of all, duck walks inconveniently. If it becomes lame, it struggles to walk. Lame duck in stock market is a broker who commits to deliver securities at a fixed date, but he finds it difficult to meet his obligation because he does not possess those securities. Then he is said to be struggling like a lame duck. Stag. Stag is an animal with beautiful branched horns. During fight, it defends itself against enemy through these horns. In stock market, stag is a broker who is more cautious in his dealings. Usually, he applies for shares in new issue market and sells them at higher price in future date when price of those securities increase. He sells them at a profit but very careful. Then these are the speculators. The next category of members are market makers. Market makers are the dealers who create and maintain market for a particular type of securities through their large size dealings. They buy and sell security on their own account at their own risk. Usually in foreign exchange market, these are very familiar like market makers and market takers. Market makers are huge corporate entities and they create the price. Those who follow that, they are called market takers. They usually give two-way quotes, that is they give two prices like offer price, sell and buying price, etc. At the time of price quotation, the other party does not know whether he is a seller or a buyer. The difference between offer price and bid price is spread for him. Market makers are significant in foreign exchange market, that is what I told you. Then last one is the broker dealer. Broker dealer is one who may buy and sell securities on his own account or as an agent. He can handle purchase orders. He can act as an agent, buy shares from other market makers. He can buy securities on his own account and resell them. That's all in brief different members of